One of the great things about One Rental at a Time is we've attracted the best of the best across the industry. We've got Taylor from Life Goal Investments, man. How you doing?
I'm doing great. Thanks so much for, again, already telling lies right out of the gates. Best of the best. It's just me. No, no,
Yes.
I appreciate you though, Michael. Thank you.
Yeah, one of the things that I want to do here is actually have a conversation I've never had recorded. I've never recorded this, never shared this with the audience, but we've had conversations like this with you and others in my community. I want to talk about the difference that you see in a seven-figure client versus maybe an 8 or 9 figure, right? You have been in private wealth, private banking. You have dealt with the top 1 point, the top 1/10 of 1% or whatever the hell you call it, the richie rich, the family
Yep.
offices for a long time. I want to talk about what similarities and what differences you see, because I certainly see differences, but again, I want to get your opinion. So kind of break that down for us. Somebody who's worth $1 million versus 10 or 100 million. What are some of the differences?
Yeah, I think what they have realized, the folks of the wealth that you're talking about there, is they've realized what they're good at. And they also conversely realize what they're not good at. And they are hyper focused on exploiting what they're good at and how they can differentiate themselves versus every other person out there. And so it's them having spent time doing whatever they're doing in their careers. It's generally them launching a business that gets them to that level of wealth. And that business was only launched after they have found that niche that they can differentiate themselves in. And it's not generally a very broad based niche. It's here is what I'm good at. Here is how I can articulate the difference between my abilities or my firm's abilities and everybody else's. And if you need this service, there's no one better to come to than whomever it is.
Yeah, that's one of the if I were to ask that same question, that's kind of where I would go first is I think you could be an employee and pretty easily earn the seven figure, whether it's stocks,
Yep.
real estate,
Yep.
whatever.
Yep.
I think the 8 and certainly the 9 figure, you've got to be an entrepreneur. And more importantly, you have to be a successful entrepreneur, right? So I certainly think that
And
is that I agree with that.
And one thing on that, and this is something that may seem so obvious, but it's something that people don't prepare for, is there is a lot of financial preparation when it goes from you being an employee and understanding your value and understanding where you can bring that business on the outside when you take that leap to become an entrepreneur. Where some people fail, where they would have been successful, is not financially preparing themselves well enough on the front end because the unforeseen happens more often than you know. Whether it's a recession in the economy that backs up, the need for every underlying service, or whether it's again, when you launch a business, it just takes more capital than you think every single
Yeah.
time.
Yeah. So again, when you think about the 8, and the other thing I want to ask you, because again, people basically buy your time, buy your advice, right? They
Mm-hmm.
sit down, it's private, it's not in a public forum. Are the 8 and 9 figure folks, do they plan more for the future versus seven figures, just like I'm going to rinse and repeat what I did last week? Is that fair or not really?
Yeah, there comes a point in their life where all of a sudden they look at the number and they go, "Oh shit, this is
That's a
this is
lot.
this is more than I have the ability to handle." And this is the greatest thing, Michael, is like when they come to us. So we run their investment assets for us. That's the service that we provide for other
Right.
folks.
Right.
Is they generally take a step back and they say, "I just realized where I'm at right now." And maybe they came from another financial advisor elsewhere that they weren't happy with and they had this realization before. But they say to themselves, like, this is not what I do. They say,
Right.
I'm educated because you can't get there educated or I'm smart, whatever it is. I don't mean
Right.
time in a classroom. I mean, I have a
Yeah.
strong
I have a
aptitude.
domain expertise like this
Correct.
narrow. Right.
Correct. And this is not my domain expertise. And so, whatever fee that we're going to charge them at the end of the day, they have a much easier time stomaching the fact and the thought that we can outperform that fee by a multitude versus what they can do on their own. Their time is their valuable asset, just like ours is. So,
Yeah.
the more time they spend on the avenue that's created the success that they have, the better off that their overall net worth is going to be. And that does not mean that they then have time to go out and think that they can manage assets in a market, especially one like this that has proven to be pretty darn difficult on most folks. And the biggest thing that people
Yeah.
come to us with, and this is, 7 figures, 8 figures, 9 figures, all of them, is an uncomfortability to the market and thus carrying an amazing amount of cash. Amazing amount of cash.
Wow. Yeah, that's interesting. And again, there was a time where, if you go back historically, cash is trash, right? The famous Dalio quote. I would argue there was a time, probably 2022, where cash was the thing to have. The 60/40 was atrocious.
Yep.
Obviously, what we've seen, at least in the last, I don't know, 4 months, 5 months, is uh, being in cash has really been hurtful, right? As the
Correct.
market's ripped. So all of that. So there is, that's interesting. So would you say, like, historically speaking, people had cash, 10, 15% of their portfolio?
Yep.
And
Right
maybe,
now, a lot of them are north of 50
I
and
was gonna
sometimes
say,
significantly north of. So rewind, like look backwards last year.
mm,
Last year, you come into the year, everybody and their brother is screaming for a recession.
yep,
And at the end of the day, you look at a money market, CD, short-term treasury, what have you, they're yielding
5%, yeah.
5%. Then you have to start to have the realization also, though, that okay, 5%. One, just in the onset, before we even get at the percentages, you have
Yeah.
to understand this. What is cash? Cash is a riskless asset.
Okay.
There is no risk associated with cash. At what point throughout history does a riskless asset perpetually outperform? It
Yeah.
doesn't. There's no
Yeah.
risk associated with it. And thus, you can't expect a higher reward out of it. But rewind back and say 5%. Okay. What people fail to realize is that whether it's a CD, it's a money market, that is taxed at your ordinary income rate. And
True.
this is where rich folks start to say, oh, no, I didn't realize that. If you tax 5% and you just look at federal,
Yeah.
5% at a 37% federal tax bracket for those in the highest tax bracket, that after tax return is 3.15%. That doesn't
Yep.
sound quite as attractive, does it?
No.
Cash is the least attractive from a tax efficiency standpoint of any asset class you can invest in. And what they need to have the realization of is like, listen, I'm not saying throw risk to the wind. I'm not saying just go out and buy equities or stocks and hope that they continue to go up, because they absolutely have the tendency over time to experience 30% drawdowns. And you
Yeah.
don't want that. No one wants to have to get rich twice.
Yeah.
And that's something that you certainly don't want to leave yourself exposed to. But let's look at things like municipal bonds.
Mm.
If you're in the highest tax bracket, municipal bonds right now, triple B, investment grade oriented municipal bonds, taxable equivalent yield, 7. It's
That's a
like,
double.
oh, okay, whoa. And okay, how much risk is associated with these municipal bonds? Not much. They default at a sub 1% rate.
Mm.
So it's just like,
Okay.
and again, you start to have these conversations with people and they start to open their eyes and go like, there's so much more to this than I had realized before this conversation.
So play this out with me, right? You had a new client that reaches out to you. Your team probably does some qualification before they get to you, I would imagine. Uh, you find out they're, I don't know, worth 50 million bucks. So you
Mhm,
you take a call.
mhm.
What um what's that call kind of feel like? Typically they're telling you what they've done today, why they're unhappy, why they're nervous, and you're asking questions about where, where would you be comfortable? You're laying this out like, hey, go from a 3-1, taxed account to 7-1. And, is that, those are the conversations you're having, or what do
The
you do?
initial call is actually more about here's what our firm does. And then the
Okay.
subsequent call, because I don't want to come on the conversation and talk about, hey, give all of your information to me right now
Okay.
before I can show you the value we're able to provide to you.
Perfect. That makes sense.
So we
Okay.
want to show all that value on the front end. And the differentiator between us and 95, 99% of the other financial advisors in the world is we have an incredibly structured process.
Hmm.
And when people say a structured process, it means, oh, other financials say we diversify. We'll hold a bunch of different assets. No, 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 no. I want
Right.
to know how those assets interact with each other,
Right.
what our exposure is to risk during different parts of the economic cycle. And I want to see numbers behind this. And I
Right.
want to understand how those assets complement each other to protect myself across all of those different economic scenarios, because we don't know what's coming next. I don't have a crystal ball. Ray Dalio, who's the greatest investor of all time, in my opinion, says unequivocally, I don't have a crystal ball. Therefore, I need to put together a mix of assets that
Yep.
can sustain all parts of the economic cycle. His portfolio is called the all-weather portfolio. What a
Yeah,
better name to understand what the purpose of that overall structure is. And
I
what
like
we're
it.
trying to do with all of our clients, we're trying to get them out of cash. The holy grail to investing is to have you know from a risk perspective that you can have all of your money invested in the market in risk assets and be comfortable with the level of risk that portfolio produces, thus not owning cash, which is a riskless asset. What a lot
Right.
of financial advisors will do is try to time the market with cash. That's called timing the market. That's not called managing risk. No one effectively times the market over time.
No, totally agree. I guess I've never asked you this. We'll ask you on video. Is there a level that somebody has to be worth before they get time with you in life goal investments? Like, do they have to be an accredited investor, or is there any kind of minimum portfolio amount?
So there's no, yeah, it's a good question. And we've struggled with this a little bit, admittedly. You'll see this with my kind of waffle around answer. Because there are scenarios where folks are, I have a neighbor who's a physician. He just paid down all of his debts. He makes an absurd amount of money, but his investable assets right now are really low. So
Yeah.
it's more qualitative than it is quantitative. We do try to set particular thresholds. They're not hard and fast because, again, this gentleman will have a few $1 million in a few years from now,
Right.
undeniably. And with that, he doesn't have a huge amount of assets right now. And so with that, we got to be smart about it. A lot of folks are like, penny wise, pound foolish. Hey, if it's not $3 million, we don't want anything to do with it.
Right.
That's not where we're at right now. And that's not the business that we're trying to build.
So if somebody who saw this, they've seen you on my channel for a couple of years now, and they had 100 grand, they wanted to place with you, is that worth it, or does it have to be more than that?
So the 100 grand kind of falls in that scenario where they have to have that outstanding situation where
Sure. Okay.
the growth component is probably there. We try to kind of set the line in the sand at 250
Okay. There we
and
go.
north of that.
Now I
But
have a number. I got a number on
there you go.
it.
Pin me on a number.
Just keep asking questions until they give me what I want. I like it.
Yeah, and then we do have, just again to the point you were making, like we do have the people that are up here. Like
Of course.
our sweet spot is here, and then we have people that are up here. And it's amazing because they pay a lot of the bills and they understand the business and they understand the value that we provide.
No. I guess the last thing to talk about, because I'm really getting a vision of these conversations, how much time do you so first phone call, first discussion is kind of telling the client about life goal and your model and why it is what it is. Then there's probably a second call where they come back and ask their questions. Are we talking a couple of hours all in, kind of client to client?
Yeah, so after the first conversation, what we'll do is we'll send them some questionnaires.
Okay.
And depending on how the conversation goes, what we can help kind of discern from those is, okay, what level of risk are you trying to take? What time horizon does this money? And the biggest arbiter of how you invest someone's money is the time horizon. Even more so than just, hey, Michael, what's your stomach for risk?
Right.
So that's on one side of the equation. The other side of the equation is like a fact finder to try to get a better idea of their overall financial life. And then we'll come together and we'll have the next conversation to say, okay, we got these inputs. We try to give them very little context so we can get the rawest information that we can out of them before we
Right.
kind of take them down one rabbit hole or another. Leave it out there, give us the information. Then we'll start to have the more qualitative conversation on that information. And then we'll present a portfolio to you after you've given all of those inputs, and you'll see exactly our expertise as to why we chose XYZ versus 1, 2, 3, and exactly how everything works in concert. I use this analogy a lot. We build a portfolio like a franchise builds an NFL team.
Mm,
Every single person on the field has a particular role, and they work in concert together. And you see that very well come across in spades when we talk about that final portfolio output.
I like it. If somebody wanted to check you out because you're putting out daily content, where would they do that?
Yeah, see us at Life Goal Investments. We're on both Instagram and on TikTok, 60-second stuff every day.
There you go. Thank you, buddy.